Hey everybody, welcome to this free edition of our Trader User Group weekly roundup for the trading weekend in January 24th, 2025. I'm Preston Brent. Thanks for tuning in. Well, the theme this week is the markets, in my mind, are still priced to perfection. Well, let's take a look at how we did this past week, and then we'll take a look at where I think we're going to be heading. If you look at it, everybody in the U.S. was in the green. Dow, S&P, NASDAQ, Russell, all solidly in the green for the week. Year to date, really a relatively strong start for the month of January. A little bit of a setback when we first kicked off the month, but we seemed to catch back up a little bit. This week was a holiday shortened week because Monday was Martin Luther King holiday here in the U.S. markets. It was also the day that headline news pretty much dominated by political developments after Trump assumed office on Monday. Okay. He didn't impose a new round of tariffs on day one, as a lot of the markets had feared here. And instead, he called on federal agencies to conduct a review of U.S. trade policies to determine, what kind of impact any potential future tariffs would have. Although he did pledge to impose 25% tariffs on Canada and Mexico as soon as February 1st, but that could be a negotiating ploy. And then later this past week, he did come back out and say he'd rather not have to use tariffs on China, which kind of helped increase the optimism in the markets that maybe he won't be as aggressive with tariffs as he did in his run up to the election and some of the talks that he gave. So these developments politically were, generally well received by investors, and I think it helped drive some of the positive sentiment early in the week. He also announced a new joint venture with Softbank and OpenAI and Oracle that he calls Stargate, which they're talking about investing up to about 500 billion or a half a trillion dollars in the construction of more data centers to help augment artificial intelligence across the U.S. So big infrastructure projects. So all of these things had a really positive impact on the markets, I believe. If you do look at, I go price to perfection. If you look at the PE ratio, the trailing 12-month PE is at over 25. The forward is over 22. So while the forward is down a little over 10.5% from the trailing PE ratio, it's still very, very high. I mean, we've got a lot of things that are going to be hitting the markets this week with earnings. Some of the Mag 7 are going to be coming out. I mean, we've got Microsoft, Meta, Tesla. We got ASML, which is the key driver in the chip market. Thursday, we get Apple. And we also get Visa and MasterCard for consumer spending. And then Friday, we get Chevron and Exxon. So it's a very, very busy week from an earnings perspective. We also get the Feds. Huge numbers on Wednesday. Everybody expects them not to raise the rates. However, the forward guidance is going to be most important. The markets have only priced in about a 24-25% chance of a rate hike in June. In fact, the markets are saying now only expect rate cuts for the rest of the year. So no rate cut this next week. And then let's see what the forward guidance says. And then the other thing we've got is the PCE, personal consumption expenditures, this coming Friday, which is a preferred Fed inflation gauge. So this week, we're going to see a lot of movement in the markets, I suspect. Okay. Now, in economic news, we did get the S&P Global first estimate of January economic activity. And it showed that business activity slowed a little bit in the month of January, but still in expansion territory, just a little bit over 50. So that's not bad. But we did get the consumer sentiment. It came in just a little bit in January. A lot of people are concerned about rising inflation expectations and concern about employment. And then finally, in the Treasury market, U.S. Treasuries generally had negative returns heading into Friday. Yields increased just a little bit across all maturities. So we're still seeing sticky inflation, yields rising. So that tends to put a little bit of a downward push on the markets. Okay. You can see the best performer for the week, communication services. The worst was energy. Trump at his Zoom call with the World Economic Forum is really pushing for OPEC to start cutting oil. And then he's got his drill, baby, drill, which tends to be more bearish oil. His view is if I can get oil prices down, then at the pump prices come down, that will lower inflation. Because every manufacturer, energy is a big use. So, and it's a right view that, if he can get that cost of oil down, then inflation will kind of come down in time behind it. The annual performance right now, even though we're only three weeks or so, 4 weeks into the new year, industrials are up 6.6%, very strong. A lot of that is through infrastructure pledges that Trump's putting out there. Staples is underwater 90 basis points. So I suspect that's going to change as we move through the month of February. If we come in and look across the pond, let's look at Europe first. You can see pretty much in the green. The FTSE is the only one that was in the red for the week. But year to date, Europe has gotten a stronger start, as you can see, than most of the U.S. markets. We did see business activity in the Eurozone kind of came up just marginally in January. In fact, the composite S&P Global showed PMI in Europe came in at 50.2, but if you strip out manufacturing, it's still in the red. And we also are getting the ECB coming out, reinforcing their view that the central bank's going to likely lower their borrowing costs for a fifth time this January 30th. So we've got the Feds this Wednesday, and then Thursday we get the ECB. The Feds probably will not, well, the odds 99% say they're not going to cut the rates this next week, but everybody wants to know the forward guidance. That's the most important piece. And then the ECB talking about cutting rates 25 basis points. Now, if we go over and take a look at the Asian markets, you can see Nikkei, China, Hang Seng, all in the green for the week. Only one in the red year to date, a major market that we follow, is China. Okay. Now, Japan, as I told our members, and I'll show you the chart, I've been looking at being bullish the yen. Bank of Japan did raise their rates this past week, third time in a year going back. They raised them 25 bips. Okay. So now their current rate is 50 basis points or 0.5%. It's the highest rate they've had it since 2008 global financial crisis. The yield on the 10-year Japanese government bond is up to 1.23%. Last week it was 1.2. So that's a lot for Japan. In fact, the Bank of Japan is widely expected to hike their rates again another 25 bips later this year. Their inflation target is, the risk is to the upside for their inflation. So that does give room for the BOJ to hike their rates. Now remember, as the yen goes up, the dollar typically will go down. The Asian equity market, especially Japan, tends to go down when they do that. And as long as they don't surprise the market like they did with the carry trade this past August, our markets, U.S. markets, should handle it okay. Okay. And then, of course, we go to China. They had a rare up week. Year to date, they're in the red. But they had a rare up week, primarily because of news that Trump may be taking a softer stance on China tariffs, but we're not sure yet. Okay. Chinese banks did leave their 1- and 5-year loan rates at 3.1 and 3.6% respectively. That's for the third straight month. However, analysts pretty much believe that the central bank there, the People's Bank of Japan, is going to start or continue easing monetary policy there. They're still pumping money into the economy, just like they are in Japan. Okay. They're also looking at cutting again the reserve ratio requirement and interest rates for banks. So that's their primary means of stimulating, and they've been putting money in trying to recover from their real estate crisis and then their COVID lockdown. So they're still having a hard time of it, as you can see here with their annualized returns. What I want to do is just shift the screen over. Let me take you to the charts. We'll go through the major indexes and some of the major asset classes here and wrap it up for this weekly roundup report. What I'm going to take you to is the E-mini S&P 500 futures. First, we always look at the S&P futures. And these are futures with a contract expiring in March. Okay, you can see here that we've been moving steadily up. When we got into January right here, we moved up and then we sold off, came down to my target level right down here, and now we're moving back up. I told you guys down in this level down here, once we hit our target, we're probably going to run up into the Fed meeting. with all the positive news with Trump in office and some of the things that he's going to do, cut regulations, um, pump a lot of money and get a lot of corporations to come in here and hire more people, that kind of thing. That's a big plus for the markets. But the other thing he wants to do is cut rates. And some of his policies, particularly tariffs, can actually increase inflation. So it's going to be a tough time of it with Trump in office as far as fighting inflation and interest rates versus cutting interest rates. We're going to see, but you can see here it's almost like a double top. Okay. I do believe that because in the E-mini futures, the last all-time high we made was on December 16th. So I think we'll probably edge up into that, make new all-time highs, and then we're going to take a look at where we are post Fed meeting this Wednesday and Thursday. It's going to be big meetings. And we also get these earnings out with some of the Mag 7. So that's also going to help out. If we look at the equal weight SPX, which I want to show you here, you can see here that roughly the rest of the stocks, they've been moving up nicely as well. We hit new highs on the 24th of January, up 4.29%. Okay, so that's right up there with the S&P. But if we ratio this thing and put the equal weight in the numerator and the SPX in the denominator, you can see here it's almost even, break even from where we started the year. So we're still getting that strength from the Mag 7, okay? And if we look at the Mag 7 stocks, this ETF that only tracks those 7, you can see here that we have not made new all-time highs. It's a little bit weaker. One of the things slowing it down is Apple, because Apple is having a hard go of it. Their earnings come out this Thursday. So all eyes are going to be focused on Apple. They're down. I'll show you a chart here. In fact, let me just show you right now. I'm going to put Apple on the screen. And you can see they've been holding a lot of the Mag 7 down. Look at that. Apple is sitting right on their 200 EMA, broke through their 50. The 50 EMA's got a downward vector on it. The 200 EMA is actually flat. So this is going to be a key earnings period for Apple. Elliott wave theory suggests it's going to move up probably to the 50 EMA and then roll back over again. So it's going to be real interesting to see how this thing plays itself out. It's not even saying that Elliott wave 3 is down. It's suggesting it can go lower. If Apple breaks the 200 EMA, it's going to be a chain reaction for other mag stocks. So we've got to watch it very closely on Thursday. The other one that's coming out this week is Microsoft. And Microsoft comes out on Wednesday. Okay, they're going to come out along with Meta. Microsoft is up, but the all-time highs were way back over here, back last year. But they've cleared the 200 and the 50 EMA. So we're going to see where Microsoft is going to come in on this. And then finally, the only other one, which I like this one as a potential buy, is Meta. You can see Meta here is making new highs. Although the bearish divergence is setting up here, it's an Elliott wave 5, which suggests that the end of this run is getting close. So we've got some key numbers to follow. The other one that I like very much is ASML. Now, it came down hard with the rest of the chip companies, but I do love this one, all right? I think this one can do very well. All the major chip companies and all the AI companies, even NVIDIA, have to buy ASML machines because those are the ones that actually create the chips that NVIDIA uses and others. So really interesting here on this, but notice it's below the 200 EMA, the 50 is below the 200. So until it clears all of these, I'd have it on your watch screen, but that's kind of how I would play it, right? So those are just some of the things that I do like. If we just swing back up here again, let me just get this off the screen here, and we go back to the major indexes. If we look at NASDAQ, you're going to see here where NASDAQ has not made new all-time highs yet. It's part of the Mag 7, so they're running a little bit shallow. But let's look at the Dow. The Dow was able to make new all-time highs. Well, not all-time highs, but new 2024 high or 2025 highs. So it's cleared both the 50 and the 200, right? And then the Russell also is way away from the all-time high made on November 25th. So it's probably one of the weaker ones of the group, okay? So these are just some of the things that I'm looking at here. And then, of course, if we come down here and look at the, let me just look at the front month volatility skew right here. You can see in the front month volatility skew, we're in the green. So that just suggests that the markets don't seem to have too much worry right now. The skew is normalized, or it's in a contango situation. Here's the VIX. We're still in the yellow, which means it's a caution zone, which means that if we do get unexpected news with some of these earnings this next week from the Mag 7 or Apple or Meta or Microsoft, or we get some wording from Boom Boom Powell, that would be Power Ranger Jerome Power Ranger Boom Boom Powell. If we get some bad words from him on guidance for future rate cuts, it can set the markets off. And we do get more inflation data on Friday with the PCE, personal consumption expenditures, which is one of their preferred inflation gauges. So the story is set for the markets to move around a pretty good bit this week. So we have to follow it very closely. And then lastly, if we look at the 10-year interest rate right here, you can see the 10-year interest rate is year to date. The high here was up 23.6 basis points from where we opened the year, but it's still higher than normal. We're still sitting around 4.62%. We moved through my target zone. We came back to my target zone. It tends to be an area where it conjugates here. You can see there is very little divergence here from this peak to this peak. That does tend to suggest interest rates will slide a little bit higher, which means the 30-year bond is going to move a little bit lower. Bonds finished up a little bit, but you can see we blew through my target and bonds to the downside, but we're in the red for the year for the long-term bond, right? And members, this Sunday evening, we'll spend a little bit more time on bonds, interest rates, and the Japanese yen, and how a lot of these things are tied together. It's very important. Even if you don't trade it, you need to understand what's happening from a macro perspective. So bonds are down. If we look at the 2-year interest rate or the 5-year interest rate, you could see here, even on the 5-year, it's been moving up, right? I mean, if we look at it on a weekly basis, just put it on a weekly basis. Let me get this all set back up here again. If we look at the 5-year interest rates, you could see here going back in time. I mean, interest rates have just clearly been moving up out of COVID when the Fed started raising their rates. The minute they started cutting their rates last year, right in this area here, when they started cutting their rates right here in last September, 5 years started going back up again, right? And that's counterintuitive to a lot of people. But if you understand what the rate market means, interest rate market, which is like the oil that lubes the capitalistic engine in the U.S., you can understand that Trump's going to have a hard time, I believe, getting the longer term interest rates down. The only way they've got to do that's show the world that they're good at cutting the deficit. So if we do all these tax breaks, they're going to have to do some serious cuts in government expenditures to get that percent of debt down to the U.S. GDP. That's going to be a hard lift, but I think Trump can do it, but he's going to have a fight all along the way to do it. If we look at currencies, let's look at the dollar first. You can see here, once Japan cut their rates 25 bips, then you can see the dollar, it affects the dollar. We went through my target. Now we're back in the red. In fact, let me just put it on a week daily chart here so you can see a little bit better. You can see on a daily chart, we hit a low for the year in 2025, right? This was the closing price of 2024. So we're in the red. We're sitting just slightly below the 50 EMA. I think the dollar is going to go a little bit lower. But if interest rates stay elevated, it's going to keep a little bit of upward pressure on the dollar, okay? And then, of course, when the dollar goes lower, the euro goes higher, right? So here we go right here. The euro regained the 50. So I do like the euro to the upside, but right now I don't. This is an Elliott wave pattern that suggests it could go back lower again. So I want to see this thing float itself a little bit longer. You see how the 50 EMA is well below the 200. So it could be a little bit of a dead cat bounce, which is what this chart pattern suggests. And it does suggest the euro could go a little bit lower. So if I just let the system calculate it for me and put it on here, You could see we hit this target very nicely, which was generated months before. So now this target here is not completed. It's suggesting in March, April timeframe, the euro can go back lower again, not quite at parity, but it does suggest more tough times for Europe, especially if the ECB says they cut their rates again, okay, and we don't cut the rates. That'll reduce the parity between or increase the parity between the US dollar and the euro, which would suggest more downside for the euro. But let's look at my favorite currency right now, the yen. Okay. The yen is still in this downward track right here. You could see this regression channel. My target was right down here. You could see this Elliott wave 5, a little bit of a bullish divergence, but you could see all this chop in the MACD line and the signal line. I want to see the yen get above the 50 and hold it and start moving to the 200 EMA, but we've got some option plays that could play this to the upside, which I do believe longer term, that's where the yen is going to go. It'll put downward pressure on the Japanese markets, but the Nikkei, but we'll see how that plays itself out, right? Then, of course, if we come down and look at gold, I think gold is, you can see here gold, I haven't even adjusted it yet, but it made new highs on Friday. So I think gold is going to probably come up and take out the 2024 highs. And then we're just going to refresh this thing and then see. It is an Elliott wave 3, but I do believe gold is going to start to run into some issues up here. But if we have a market pullback and inflation stays stickier, you'll see some more upside in gold, right? Same thing with silver. Silver is had a good strong week. Silver is lagging gold as it did last year before it finally caught up. You can see silver just regained its 50 EMA, has not made new 2025 highs as gold has done. So we'll see how that plays out. Energy, let's look at oil right here. I do like shorting oil up in these prices up here. I talked about this before. I don't see oil getting much higher than this. In fact, 80 surprised me. I expected maybe mid 70s. It went even higher than that. Now this Elliott wave count suggests oil is going to catch and move back up again. I don't see that with the pressure Trump is putting on oil. In fact, my original target way out in the summer of next year, or this year, it was next year, last year, was around $62 a barrel. And we could get down there. So there's a wide range here with oil. Members, we'll talk about trading this one as well. I think there could be some good trades in the oil market. We do have Chevron and Exxon coming out this Friday for earnings. So we'll see how that plays itself out. Nat gas, well, it's going to stay bullish, but it's very difficult for nat gas to stay bullish above these levels right here. They're going to be opening these LNG ports. Trump's going to be hiring, or the U.S. is going to be hiring a lot of people, port people, to get the nat gas pipeline down to the Gulf and then shipped over to Europe and over to Japan, because their natural gas costs are 3 times the cost here in the U.S. So that's going to keep natural gas higher for longer as we pump more to get it down there. But we got more excess capacity in that gas than we even do oil. So it's going to stay bullish, but it's going to have a hard time getting up above these levels up here. Every time it gets up and makes new highs, to me, it's worth setting up some option trades where you sell out of the money calls, or you sell puts underneath. But I think the market is more likely to run sideways for the near term in nat gas. Okay. So anyway, these are just some of the hard assets and commodity classes that I see. And what we're looking at as we go into this new week. This is going to be a very, very busy week for the markets, very busy. So we got to watch it very closely with everything that's coming up. All right, everybody, have a great weekend. Great football on tomorrow. Members, I'll see you tomorrow evening at 7 p.m. for our weekly market watch. Take care, folks. Ciao.